When we're dealing with any sort of valuation, it's really easy to get caught up in the numbers and building the actual spreadsheet. But when we're analyzing other folks' valuation, what's really important to do is take a step back and realize what are the problems that I'd face by analyzing somebody else's work. And the first thing that comes up is that whenever you're valuing any sort of asset, there's some sort of bias of the person that's actually doing the analysis. So let's talk about what is this bias that exists. So this is what I, call, an author's bias. Whenever you're, producing, in the case of finance, you're making a model, there's going to be some sort of bias, and that bias starts really early on. So it's really important to understand that all valuations are going to be biased for some reason or the other, right? When I wrote this report this week, this article, I talked about a company called 2U. 2U is an education technology company, right? And I have a strong preference for education. I, work in the industry, the education industry, run an EdTech company. I really, really like the space. So that one led me to analyzing companies in this industry. And specifically, I like EdTech. I think it's very innovative. It has high impact. It's going to change the world. So when I'm thinking about valuations, I'm, inherently more optimistic than a person that maybe doesn't like tech as much, is more maybe on the manufacturing end of the spectrum and likes businesses that are more capital intensive and have actual tangible assets rather than intellectual property in a tech business. So I have this preference for educational technology companies. And it's important to understand that preference that you have, or the analyst does, when you're going into any sort of valuation paper. Now, this bias starts to form when I'm picking stocks. So now I know, or I am interested, or I have to cover the education industry. But now, like, why am I choosing to cover a specific stock? Well, there has to be some sort of reason, right? So if we look at the case with, why I thought I'd analyze and write about 2U, well, it should be pretty apparent, right? When we look at, this is a chart of the performance in the education industry. So this is education more broadly. And we can see overall, so this is, on a relative basis, all benchmarks starting the year at $100. And then we see, at the end of one year where these different education companies will lie at the end. And we can see here who was the lowest performer. Well, it's this orange line that you can see, lost a majority of its value. It lost more than half of its value, more than 90% of its value, in fact. And who is that? Well, we can see here the orange is the company 2U. So why did I pick this stock? Well, I wanted to see if it was actually undervalued or if it deserved to be really, really negatively impacted because of its actual operations or its financials, whatever that might have been. Anyways, when you strip out all the other educational service companies, you're left with just the edtech companies. So the most directly comparable companies, right? This includes names that we might be familiar with: Chegg, Coursera, Duolingo, 2U, Udemy, Varsity Tutors, and things of that nature. And we can see here, really leading the chart was Duolingo, which went up 2.2 or 2.3 times that year. And you can see here, 2U still sits at the bottom, far from lost almost 90% of its value here. Almost 90% of value is lost, far from the next worst performer, which was this one here, which is Coursera. Or actually, this is not Coursera. The colors look similar there. Coursera did a little better. This is rather Chegg, I believe. This is Chegg, which is the homework solution stock. And they also got hit for, similar reasons. We can talk about generative AI and maybe the effect in these companies when building content and providing, in the case of Chegg, homework solutions. But anyways, that's past the point. What I want to talk about is how a company performs is a source of bias. If a company has been performing really, really, really badly, as is the case with 2U, it's lost 90% of its value over that year, I'm probably going to be more pessimistic. I'm going to say, what's wrong? What's going on that's wrong here? As opposed to coming into the valuation saying, hey, where can I apply premiums? Where is there, ability for the multiple to expand and margins to go up? I come in and say, what's wrong with this business? Why is it performing so poorly? So right away, there's a bias that exists. So there's a bias that starts right at the beginning in terms of, why are you covering the sector? You might have to cover it if you work at a bank, but if you're covering it just to learn about companies, you probably like that industry, or you're optimistic or interested in that industry. Next, when you're actually selecting the actual specific stock, there's a bias there, either underperformance, overperformance, or you have some way of hearing, observing, thinking about the stock before you actually come into the valuation. So it's important at least to address that, right? So then it's the question, like, what are the fundamental questions I should be asking, myself when I'm doing any sort of valuation, right? Well, the first one we just covered, which is, why are you doing the valuation in the first place? So why do the valuation, or why, even pick the specific asset that you might be looking at? Right. Then the next question we might want to ask ourselves is, what do we know about management? What do you think about management? Do you, like, do you dislike the management, right? And a lot of times we can see these type of companies, that have done, to you, didn't only do bad in over 2023, they are also, going pretty much downhill since 2018 when they peaked. So they've lost 99% of their value over the last 5 years, right? This massive value destruction. So as if I were a shareholder maybe, or just watching the stock, I would be pretty frustrated given that over the last 5 years, I'm seeing that 99% of its value has been eliminated, wiped out. Right, as a shareholder, maybe I'm not too happy with what management is doing or how management is operating the business, so I now have a bias going to that valuation, right? And then finally, on pretty similar to what we're kind of discussing here, is, do you own the stock? Do you own the stock? If you own the stock, you might be a little more emotional because you actually have an investment. Your own money is at stake, whether it goes up or down. In the case of 2U, massively down, right? $1 turns to 1 or 2 cents. You're not going to be too happy with what's happening there. You're going to be more skeptical of what the company has to say. So that brings us into our last point, which is that there's some sort of investor bias that exists, right? And we can see this here. We can see this here with so somebody that most people know, which is Cathie Woods. Cathie Woods is a big fancy tech investor that really was known for Tesla, for being the biggest bull on Tesla. And while this was all great coming out of COVID in 2020 into 2021, when the market was so focused on growth, the same thing happened with 2U. You can see here, this chart kind of details her purchases, and you can see here one of her biggest purchases here, which was in 2020 in quarter 1. It was one of her biggest purchases here. You can see about 8 million shares she acquired, quite a bit of stock there. And simultaneously after that purchase, she wanted to justify it, right? And on Twitter, we can see that she had a post here. She did a podcast with somebody else on her team, I believe, and it says that this is a very innovative company that's gaining traction during really tumultuous times. Yeah, no doubt. It's COVID. Everybody's online. Nobody's actually in school. So a business like this is really going to turn to the attention of investors, right? But is that something that's going to be long term, or is that going to be more of a temporary blip? And in the case of 2U, it's a little more temporary, and it's harder to continue to roll out these digital programs as colleges are beginning to do it in house, and it's just too expensive, in terms of the business model they operate. So here they say to use, could be a victim of some mindless algorithms without any understanding of the business, aiming at negative free cash flows. Well, yes, this is true. We're going to see that, this company is very, very negative when we think about earnings. And likewise, its cash flows and its ability to generate cash is not too attractive. Although management is trying to change this through a new kind of, business or pricing model, which we'll talk about later, which is the flex model, which, maybe looks a little better. But this is Cathie Woods coming in and buying 8 million shares, a substantial amount of shares at a pretty high share price. I believe is around $30 or $40. So massive destruction down to $1 per share today. And she's coming out and saying, this is a great company. That's misunderstood. So going back to our point, we have to understand exactly where the biases are going to come from. Or the biases are going to come from are, even before we choose a stock, then it's going to come from what we know about the company and the actual stock. What is management like? Do we like or dislike? And then it's going to be further affected by are we actually invested? Do we have something in stake in this company? And if we are, we're going to be more emotional, and we're going to, in the case Kathy Woods is going to put positive propaganda out, into the market in order, for that positivity to hopefully continue and drive up the stock price. So, her or whoever invests in the stock is doing good. So it's really important, before you even start looking at anybody's valuation or going into a valuation exercise, that you're, stepping back and asking, what are the valuation biases that I see when I'm analyzing?